In the spring of 1720, the man who had decoded the laws of gravity found himself utterly defenseless against a force he could neither calculate nor control. Sir Isaac Newton, a brilliant intellect and master of the Royal Mint, invested heavily in a rapidly ascending stock, sold it for a handsome 100% profit, and then watched in agonizing regret as the price continued to soar without him. Yielding to the intoxicating pull of the market, he plunged back in at the absolute peak, ultimately losing £20,000, a sum equivalent to millions today. His reputed lament, that he could calculate the motions of heavenly bodies but not the madness of the people, captured the essence of a systemic contagion that had hijacked an entire empire. This was not an isolated miscalculation by a solitary genius. It was the apex of the South Sea bubble, a financial mania so profound that it warped the economic reality of the British Empire. At the center of this hysteria stood a single corporate entity whose market capitalization temporarily eclipsed the total wealth of the nation it served. Yet, the most perplexing aspect of this valuation was not its sheer size, but the vacuum at its core. The enterprise commanding this astronomical premium was a trading company that conducted almost no actual trade. To understand how a hollow enterprise captured the capital of a global superpower, one must examine the crushing fiscal realities of early 18th century Britain. Decades of relentless conflict, primarily the War of the Spanish Succession, had left the British government burdened with an unmanageable national debt. The state owed roughly £50 million, a staggering liability characterized by high interest rates and fragmented illiquid obligations scattered among thousands of individual creditors. The treasury was suffocating, and traditional taxation was entirely insufficient to service the mounting arrears. The geopolitical survival of the nation depended on finding a radical mechanism to restructure its sovereign liabilities. The solution arrived not through fiscal austerity, but through an audacious feat of financial engineering. In 1711, the South Sea Company was chartered with a proposition that seemed elegantly simple. The company would assume a massive portion of the government debt. In exchange, the state would grant the corporation a perpetual monopoly on trade with the Spanish colonies of South America, while paying a guaranteed annual interest rate on the absorbed debt. It was a monumental debt-for-equity swap, transforming disparate government obligations into shares of a single, theoretically lucrative, commercial enterprise. The state secured lower interest rates, and the creditors received liquid equity in a promising venture. However, the foundational premise of this arrangement rested on a geopolitical illusion. The lucrative ports of South America were fiercely guarded by the Spanish Empire, which had no intention of opening its colonial wealth to British merchants. The treaty that ended the war granted the South Sea Company the right to send merely one ship per year to these restricted waters, a concession heavily taxed and strictly monitored. The promised monopoly was essentially a fiction, a grand narrative constructed to obscure the reality that the company's true business was not maritime commerce, but sovereign debt manipulation. The physical ships were nothing more than a marketing facade for a vast financial derivative. Recognizing the severe limitations of their maritime operations, the directors of the South Sea Company pivoted entirely toward the corridors of political power. By 1719, they proposed an even more ambitious scheme to take over the entirety of the remaining unconsolidated national debt. To ensure parliamentary approval against fierce opposition from the Bank of England, the directors deployed a sophisticated campaign of institutional bribery. They distributed secret shares to key government ministers, members of parliament, and influential courtiers. These shares required no initial payment. The recipients could simply sell them back to the company once the price rose, pocketing the difference. It was a perfectly aligned incentive structure that guaranteed legislative support by directly enriching the lawmakers tasked with oversight. With political backing secured, the company unleashed a masterful, if deeply deceptive, strategy to inflate its share price. The mechanics of the debt conversion dictated that the higher the South Sea stock climbed, the fewer shares the company had to issue to government creditors to retire a given amount of debt. The surplus shares could then be sold to the public at exorbitant premiums, generating massive cash reserves. To manufacture relentless upward pressure, the directors began offering generous lending terms to investors, allowing them to buy stock with small down payments while using the purchased shares as collateral. The company was essentially printing its own credit to artificially stimulate demand for its own equity, creating a closed loop of synthetic value. This self-sustaining loop of credit and speculation ignited a nationwide frenzy. The stock price surged from £128 in January of 1720 to over £1,000 by August. The mania transcended class boundaries, drawing in dukes, shopkeepers, poets, and politicians. Taverns and coffee houses transformed into makeshift trading floors where fortunes were made on paper overnight. The atmosphere of guaranteed prosperity birthed a secondary market of imitators, colloquially known as bubble companies. These unregulated ventures raised capital for increasingly absurd propositions, ranging from extracting silver from lead to, most infamously, a company carrying on an undertaking of great advantage, but nobody to know what it is. The architecture of this speculative boom contained a fatal structural flaw. The illusion of infinite wealth relied on a constant influx of new capital to sustain the inflated share prices and service the margin loans. The directors of the South Sea Company, growing alarmed by the capital being diverted to the rival bubble companies, leveraged their political influence once again. They successfully lobbied Parliament to eliminate their competition, resulting in the passage of the Bubble Act in June of 1720. This legislation required all joint stock companies to possess a royal charter, effectively outlawing the myriad of unauthorized startups that had sprouted in the company's shadow. The Bubble Act achieved its immediate goal of crushing the unauthorized ventures, but the victory was purely Pyrrhic. The sudden collapse of the rival companies triggered a severe liquidity crisis across the broader financial ecosystem. Investors who had leveraged themselves heavily to buy into the smaller bubbles were suddenly facing total ruin. To meet their immediate financial obligations and cover their mounting debts, these speculators were forced into a corner. They had to liquidate their most valuable and easily tradable assets, which meant they began dumping their shares in the South Sea Company en masse. The sudden wave of selling pressure exposed the fragile foundation of the entire enterprise. As the South Sea stock price began to slip, the margin loans issued by the company became dangerously under-collateralized. Investors who had bought on credit faced devastating margin calls, forcing them to sell even more shares to cover their debts. The self-sustaining upward loop violently reversed into a self-reinforcing downward spiral. By December of 1720, the stock had plummeted back to £124, vaporizing the paper fortunes of a generation in a matter of weeks and leaving behind a landscape of financial devastation. The contagion was not confined to the British Isles. The mania had run parallel to an equally disastrous financial experiment across the English Channel. In France, the Mississippi Company, engineered by the Scottish economist John Law, had attempted a similar monopolistic debt conversion, leading to a spectacular boom and an even more devastating bust just months prior. The intertwined collapse of these two massive financial experiments created a pan-European liquidity crisis. Capital fled the major financial centers, international trade routes stalled, and the nascent global financial system experienced its first synchronized cross-border systemic shock. The implosion sent a catastrophic shockwave through the domestic British economy as well. The sheer scale of the wealth destruction paralyzed commerce and froze credit markets entirely. Prominent aristocratic families were bankrupted, merchants defaulted on their international obligations, and a wave of suicides rippled through the financial districts of London. The systemic failure was so profound that it threatened the stability of the state itself, as the government found its debt management strategy entirely discredited and its political leadership deeply implicated in the fraud. The public trust in financial institutions was shattered, replaced by a deep-seated paranoia. In the chaotic aftermath, the mechanics of accountability were fiercely contested. Public outrage demanded retribution against the directors and the corrupt officials who had enabled the scheme. The Chancellor of the Exchequer was imprisoned, and several directors had their estates confiscated to provide partial restitution to the ruined investors. It was during this crisis that Robert Walpole, a shrewd political operator, stepped into the vacuum. Walpole meticulously engineered a restructuring of the company and a bailout of the financial system, shielding the highest levels of the monarchy from implication. By managing the fallout and restoring a semblance of order, Walpole effectively established himself as Britain's first prime minister, consolidating power amid the ruins. The echoes of that crisis still resonated through global markets centuries later. The trauma of 1720 fundamentally altered the trajectory of corporate development in Britain. The restrictive provisions of the Bubble Act remained in force for over a century, severely limiting the formation of new joint stock companies and artificially constraining the evolution of corporate capitalism. The state had learned a brutal lesson about the dangers of unchecked financial innovation and the catastrophic potential of intertwining sovereign debt with speculative equity. The regulatory landscape was permanently scarred by the memory of the collapse. Ultimately, the legacy of the South Sea bubble is not merely a historical curiosity of powdered wigs and sailing ships. It stands as the foundational blueprint of the modern financial bubble. It maps the precise coordinates where systemic leverage, political corruption, and the relentless human desire for unearned wealth intersect. The mechanics of the 1720 collapse reveal an enduring truth about the architecture of financial markets. The underlying assets and the technological mechanisms of trading may evolve, but the vulnerability of the system to collective irrationality remains a permanent, unyielding feature of the profit matrix.